Okay, Saurabh Mukherjea joins us now, represents Ambit Capital. Saurabh, good morning. Thank you for joining us. Now, Saurabh, the correction started in India because of global factors, but globally things are looking stable and they are looking up, but locally we are underperforming massively. What has changed for us? Is it political uncertainty? Is it political anxiety which is pegging us back?
I'm not so sure that our correction is so much driven by global factors. If you see the S&P 500, I don't think it's pulled back anything like the amount we have pulled back. I think our concerns, obviously, some of it is political, but I think we make a little bit too much out of politics in this country. I mean, if you speak to some investors in Mumbai, you would sort of think that the whole country, the whole stock market hinges around politics. I think a lot of it is liquidity. Last year, especially in the wake of demonetization, we basically forced liquidity into the financial system. Currency notes were taken out of people's mattresses, shoved inside the banking system, and both in the bond and the equity markets last year around this time, we had a memorable rally as liquidity flooded through the financial system. I think what we're now seeing is the normalization of that. Cash in circulation is roaring back, bond yields are zipping up, and stock prices are correcting. Basically, we overdid the enthusiasm for the stock market on the back of a flush of a wave of liquidity last year. We're normalizing that this year. I agree with Ramdevji. I don't think there's anything particularly wrong with this correction. And as I've been saying for a long time, I think there's more to go. I think the market's still overvalued by 10 to 15% in the large cap space, and by 30 to 40% in small and mid caps.
So, Saurabh, we are underperforming when global markets are okay. Let's be clear. We saw a sell-off in the month of Feb, and after that, this entire tug of war between global bond yields and global equities, that surely has come to an rest now. My only concern is that you are underperforming when globally things are stable. What will happen if globally things they start correcting?
Yeah, I agree with you. I think in the wake, given that the US market really isn't showing any pronounced jitters, given that the US bond yield has stabilized at around the 285, 290, the 10-year bond yield in America stabilized at around the 2.90 mark. If we are under pressure, then if global liquidity dries up, we clearly have a bigger challenge. But I think, as I'm saying, our local liquidity problems are clear. Liquidity is tightening up compared to the flush liquidity conditions of last spring, last summer. And I think that's the process that will carry on exerting a drag on the market. As we can all see, it's very tangible that the economy is recovering. It's no longer a secret. It's evident in daily news flow. It's evident in sort of perceptible changes in the economy around us. And I think the economic recovery will continue. But just as last year the stock market did well when the economy didn't, I think this year the tables turn. The economy looks all set to continue doing well this year. I'm not so sure the stock market can roar ahead this year in this sort of liquidity tightening conditions.
So what are the kind of returns, Saurabh, that you're expecting towards the year-end close? Would you have a Sensex target in mind? I recall that earlier on the 30,000 number is what you were working with at Ambit. Have you revised that lower?
No, we're pretty much still there. Our point is that where the Sensex is today, 33,000 odd, it should be a year hence. So basically, we've baked in a full year, we've run ahead a year in advance, and in an ideal world, the Sensex should be roughly around 30,000 at the moment, and set for a 10% rally. But because we've run ahead of ourselves, I think the Sensex is baked in the earnings recovery. We expect FY19 earnings growth to be around 15%, and therefore, if you assume that FY19 growth is around 15%, and if you assume that fair PE multiple for the Sensex is around 19-20 times, basically fair value for the Sensex a year hence should be 33,000. And therefore, if you ask me on a 12-month basis, can I see the Sensex giving meaningful returns? The answer is no. I think the market's run ahead of itself. So either the market corrects now and thus we're able to get some return, or if the market stays where it is, I think the market's fully valued. And I'm not really focusing too much on the political side of it. Those are imponderables, and I'm not so sure politics actually has that much of a bearing on the Indian market. I do feel people in Mumbai overplay the importance of politics on the stock market.
Okay, that time will only tell in the run-up to 2019. But sort of irrespective of the February fall, would you say that there is a larger correction perhaps in the pipeline for mid and small caps? And have they not corrected enough?
So one simple sort of rule of thumb which works reasonably well in finance is, if when cost of money runs up, when cost of capital runs up, the riskier the asset class, the sharper the correction. And if you broadly assume that the run-up in the 10-year bond yield over the last 6 months of roughly 120, 130 bips, the 10-year bond yield has risen by around 120, 130 bips in the last 6 months. If you broadly assume that that is the risk-free rate of return in our country rising, then that should lead to a correction in all risk asset classes. And therefore, the greater the illiquidity, the greater the risk associated, the sharper the correction. So if I'm saying that the overall stock market looks 10 to 15% overvalued, then clearly the risk of correction is far sharper in small and mid caps, and a 30 to 40% correction I don't think is out of order there. And if you link it to sort of macro fundamentals, a rising inflation climate, and I think inflation will continue this year. I think the February CPI, I think, flatters to deceive. I think we are in a rising inflation climate in India now. A rising inflation climate is particularly punishing for small and mid-cap companies because they don't have the pricing power to deal with rising inflation. Large companies are better off in a rising inflation climate compared to small and mid-cap companies.
Saurabh, so just a question which is based on this whole concept of interest rates which act like gravity. And India may not be the right example, but if I look at globally, all the big companies in America which are growing, they don't need capital, whether it is Facebook, Amazon, Netflix, the FANG companies and the other tech companies. So why should US markets be so worried about cost of capital? Because US corporates are not getting a tax cut and they will be immune to any interest rate hike. And if US markets does not collapse too much down, then the flows, at least global flows, will not be jeopardized.
Sure. I think as you began by saying a few minutes ago, I think the concern is more for EM. The US 10-year bond yield is the world's risk-free rate, and if the US 10-year bond yield is, say, yielding 1.5%, then basically there's free money available for the rest of the world, including emerging markets, including India, to trade up on. But if the cost of money starts rising in America, if the US risk-free rate starts rising towards 3%, perhaps even 4%, then there's a reverse flow of money outside from emerging markets back to America. And I think that's what's really worrying. That's what's really worrying investors. It hasn't started yet, but it could well. And one concern that's being articulated by our foreign clients is, given that QE has stopped, given that the Fed will no longer be buying US government bonds by the bucket load, given that the Chinese are no longer buying US government bonds by the bucket load, who will buy American government bonds? And if Americans themselves start buying American government bonds, then can the American consumer then sustain the American economy if he then has to redirect money to the US bond market? So the concern around the US bond market, I think, is growing, which is pushing 10-year bond yields up. And if US 10-year bond yields go up, money goes back from the rest of the world back to the United States, effectively to finance the US budget deficit. That flow of money argument is, I think, worrying investors. The game hasn't started yet. When it starts, it'll be one of those, once in a decade return of capital to America, once in a decade return of capital to America, which notably causes volatility in emerging markets.
So, buy IT, buy pharma, stick to private banks. Should one keep it very basic and simple?
I would say you can sort of broaden it a little bit more. If you've got a recovering economy, wholesale cost of money is rising, then private banks with great CASA franchises should do well. Metals and mining companies should do well. You've got a recovering economy, global prices of metals are rising on the back of the global economy recovering. Consumer demand plays in our country, discretionary demand plays in our country. The auto sector, parts of the apparel sector, parts of the building material sector should do well. And finally, given the political backdrop of run up to elections, and given that the government is determined to spend big ticket money on MSP, on food support, I think rural plays should have a reasonable run over the next 7-8 months. It's never great to invest in stocks for a 7-8 month period, but it looks almost certain that rural plays will have a great run over the next 6-7 months.
What about roads as a sector? Because there's been an order deluge that we've seen, Saurabh, of late. What with NHAI contracting more and more highway orders and some of these private companies actually picking up those orders, and a slew of them already L1 bidders.
So I think it's a story that's been around for the last 2 to 3 years. This government has consistently spent money on roads, and the better quality road builders have already done very well. What's worrying me is now the second and third rung road builders are getting in on the act, and as is inevitable in India, as soon as the order book builds up, they're on the road to get their QIPs going, and that always worries me. So I think the top rung road builders are well recognized, they're sort of fairly valued, and they'll carry on getting decent business. The second and third rung road builders, I think, history of corporate governance issues, history of capital misallocation, and the fact that so many of these guys are looking to raise capital at the moment, I think is giving me a degree of concern around the second and third rung road builders. But roads as a theme has worked, and I think will continue working. Play quality in the road building sector. It's a theme which works in our country.
Where would you be a little circumspect, though, PSBs aside, Saurabh, where is it that you feel that it's time to book profits?
I think one area is auto ancillaries. I think the sector's had an epic run, but I think it's one of those sectors which looks set for a margin squeeze as inflation revs up, as input prices of commodity prices continue rising, just as the metals and mining sector will benefit from commodity price inflation. I think auto ancillaries are classic losers in this. They simply don't have pricing power to benefit from a higher inflation, a higher commodity price climate. Second is wholesale market plays, housing finance companies in particular. These lenders borrow money in the wholesale market short term, give 20-year home loans. I'm not so sure that's going to be a clever idea in this sort of climate with tight liquidity. And the third area, if you ask me, is private sector banks who don't have great CASA franchises. Several of them have traded up to 3 times, 4 times books. Some of them are trading up even above that. And private sector banks, where you don't have a CASA franchise, I would say you'll have similar problems to the housing finance companies.
Saurabh, so what happens in short term, it's anyone's guess. But let's say a year from now, do you think markets will be trading higher or they would be trading lower? Because a year from now, a lot of attention would have shifted to the 2019 narrative. Every second market comment or thought would be centered around what will happen to 2019 general election. So what happens to market in the interim? The macros are changing. So the cost of capital is going to change. You may get some bright pockets of activity, that's about it. But in terms of anxiety, nervousness, curiosity, a lot of things will change.
So I think let me take politics out of the equation, because as I keep saying, I think we discuss it to death, and we kind of assume that the whole market will hinge around elections. But if you look back at the last 10-15 years of data, you get day-to-day volatility around elections, but I'm not so sure it is as big a driver as people attribute it to. If I stick to fundamentals, I think the stock market should be roughly where it is a year hence. It's fully valued. The stock market's baking in. The stock market's done the job. It's an efficient market. It's baked in the economic recovery. The economic recovery is underway. I think it will continue. And broadly speaking, the stock market should be where it is a year hence. I don't think we should either expect a massive bear market or a great bull market. We've fully valued an economic recovery. What you'll see is a change in the composition. I think financials at 38% of the Nifty looks to me to be too heavy a weight in the Nifty. I think a pullback in the weight of financials in the Nifty, I think, seems to be on the cards. And as you were alluding to, I think pharma, IT, FMCG will have slightly heavier weights in the index. I think metals and mining will have a heavier weight in the index, and elements of industrials could have a heavier weight. So I think you rebalance the index, you reduce this excessive weight that the index has in banking and financial services stocks, and you increase the weight of some of the more defensive sectors and some of the more cyclical sectors around industrials and metals and mining. But the overall market, I think, will be roughly where it is a year hence. I'm not expecting a major bear market or a bull market. We're sort of evenly balanced at the moment.
Okay. Saurabh, appreciate your time and glad you could join us.